Today, is a monetary U-turn even possible? Hello again, it's Martin North from Digital Finance Analytics. Welcome to his post covering finance and problem news with a distinctively Australian flavour. The big question, which few want to answer, is how do we go about reversing the massive quantitative easing and bond programs, the massive jump in debt, and the ultra-low interest rates, which have been a feature of many central bank strategy around the world. And where are we placed in the journey from COVID, because those two things are somewhat related? Well, the renewed surge in COVID-19 infections is threatening to further divide the world economy between the rich and the poor, potentially damaging overall growth if the fresh outbreaks spread or if key sources of demand falter. More people were diagnosed with COVID-19 last week than any other since the pandemic began. The World Health Organization this week warned that new infections are increasing everywhere except Europe, led by rocketing numbers in India, and cases are also rising in Argentina, Turkey and Brazil. That's casting a shadow over a previously vigorous global economic rebound, given that failure to control the virus or to get vaccines distributed evenly risks driving new mutations, first in emerging markets and then on to developed nations that had been beating the pandemic back. And even if that doesn't happen, a two-speed recovery will restrain even inoculated countries by limiting foreign demand for their goods and destabilising supply chains. The IMF said last month that the recovery will miss out on a $9 trillion bump by 2025 unless faster progress is made in ending the health crisis. Emerging and developing economies accounted for 2/3 of global growth before the pandemic, and around 86% of the world's population. And the World Bank told them just this week that they must prepare for the possibility of their recoveries losing steam. A nascent economic revival in India, that's the world's sixth largest economy, is being threatened by renewed movement curbs across provinces to stem a new wave of infections that have topped 200,000 daily for the last week. The new case spikes represent a reality check for the world economy, as it's clear that the pandemic is nowhere close to being over, said Tuli Macaulay, head of Asia-Pacific economics at Scotiabank. Many lower-income economies continue to face severe COVID-19 related challenges and have a long road ahead before they're back to normalcy. More than 944 million vaccinations have been administered across 170 countries, according to data collected by Bloomberg, enough doses for 6.2% of the global population. But the distribution is lopsided, with the highest income countries getting vaccinated about 25 times faster than those with the lowest. I see it as a race between virus mutations and vaccine rollout, said Rob Subbaraman, head of global markets research at Nomura Holdings. Many people are not aware that while the 1918 Spanish flu is believed to have started in the US and then spread to Europe, in the end the countries that suffered most were in emerging markets. It's an ominous sign of history repeating itself. And markets are showing some signs of jitters, although today was a better day. A gauge of stocks in Asia has lagged global peers this month, while the Indian rupee is this week's worst performing currency in the region. Investors have sought out traditional havens like the Japanese yen and rewarded those with better track records of managing the outbreaks, such as the Israeli shekel, Taiwanese dollar and the British pound. Companies most reliant on a reopening of the global economy are especially vulnerable, and the latest infection surge is overshadowing a priced-to-perfection reopened trade. Stephen Innes, the chief global market strategist at Axia Corp Financial Services in Sydney, said in a note to clients recently. The glaring problem is that despite strenuous efforts by the medical community around the globe, we're not even close to calling it a day, so that people can start again or continue with things more productively, according to Innes. The spread of cases threatens what's forecast to be a V-shaped recovery for global growth led by the US and China. The IMF currently expects the world economy to grow at 6% this year. That's the most in 4 decades of data. But it knows the longer the pandemic runs, the harder it will be to meet that forecast. The window of opportunity is closing fast. Managing IMF Director Kristalina Georgieva said, the longer it takes to speed up vaccine production and rollout, the harder it will be to achieve these gains. The IMF modelled a downside scenario in which supply bottlenecks in vaccine supply and other logistical problems allow existing virus variants to become entrenched and new mutations to occur, leading to delays for reaching herd immunity of 6 months in advanced economies and 9 months in emerging markets. Under such a scenario, with persistently high infection rates and deaths slowing the normalization of mobility, global growth will be 1.5 percentage points less than in the base case scenario in 2021 and a further 1 percentage point below the baseline in 2022. The pace of vaccinations over coming months and their ability to withstand new variants will dictate the recovery from here, according to Ben Emmons, Managing Director of Global Macro Strategy at Medley Global Advisors in New York. It will take most of the second quarter to get visibility if the global rollout is truly succeeding against the variants, he said. Yet on the other hand, the Bank of Canada took the biggest step yet by a major economy to reduce emergency levels of monetary stimulus as it hailed a stronger than expected recovery from the pandemic. Up until January, when the Bank of Canada last released economic forecasts, it projected that the thresholds wouldn't be reached until 2023. The economy, however, has outperformed spectacularly relative to the Bank of Canada's projections since then. Now, policymakers led by Governor Tiff Macklem said on Wednesday that they will scale back their purchases of government debt by a quarter to $3 billion Canadian dollars, which is around $2.4 billion US, and accelerate the timetable for a possible interest rate increase. The upbeat turn toward plotting a return to more normal policy has been resisted by counterparts elsewhere, including the US Federal Reserve. Investors reacted by driving the Canadian dollar to its biggest gain since June. This is a fairly hawkish message cast by the Bank of Canada. Simon Harvey, a senior foreign exchange analyst at Monex Canada, said, they seem quite confident that once the current wave of infections subsides, the economic recovery will be robust. The central bank reiterated its guidance that it wouldn't raise its benchmark interest rate, currently at 0.25%, until the recovery is complete and inflation is sustainably at 2%. But it changed its projections on when that would happen. In new quarterly economic projections, it revised higher its growth estimates for 2021 by more than 2 percentage points to 6.5% and brought forward its forecasts for when slack would be absorbed. Based on the bank's latest projections, this is now expected to happen sometime in the second half of 2022, the bank said in its latest monetary policy report. And at a subsequent press conference, Macklem emphasised that the central bank's commitment is not to raise interest rates before the economy fully recovers, and that any future hike would reflect economic conditions at the time. The Federal Reserve, by contrast, says it won't begin scaling back the pace of its $120 billion a month bond purchases until it sees substantial further progress on employment and inflation. An economist surveyed by Bloomberg ahead of the Fed's March meeting didn't expect that to happen until 2022. Macklem's growth revisions bring policymakers more into line with economic projections. Markets had already been pricing in a rate increase in 2022 before Wednesday's change. Investors have also been anticipating that Canada's central bank will be more aggressive than the Federal Reserve in its normalization path. Swaps trading suggests about a 50% chance of a hike in Canada this time next year. Almost 3 hikes are fully priced in over the next 2 years and 5 hikes over the next 3 years. Chairman Jerome Powell, for his part, has been careful to avoid putting a date on beginning to taper asset purchases in the US, although his number 2 Vice Chair, Richard Clarida, has said he doesn't expect those thresholds to be met this year. Powell has promised to give investors plenty of warning that officials are beginning to debate the timing of a move. He's been upfront in wanting to avoid surprising markets and rerunning the 2013 taper tantrum, when unexpected news that the Fed was thinking of paring its purchases sent financial markets into a spasm with harmful economic consequences. Even before Wednesday's statement, investors were anticipating the Bank of Canada to be among the most aggressive advanced economies in unwinding stimulus. One reason may be that Canada's jobs market has recouped 90% of losses during the pandemic versus just over 60% in the US. Still, policymakers remain cautious despite the more positive tone, saying there's more uncertainty than usual that might affect its estimates for slack. Officials also highlighted concern about the uneven recovery and the potential for scarring in the labour market. The Monetary Policy Report includes discussion of several factors that could soften the need to pull forward a rate hike into 2022. We continue to think a rate move is likely to be delayed into the first quarter of 2023. On technical grounds alone, the central bank's purchases of Canadian government bonds need to be pared back as the government's financing requirements drop. It now owns more than, wait for this, 40% of outstanding bonds and is on pace to go above 50% in a few months as Prime Minister Justin Trudeau's government reduces its issuance by around 90 billion Canadian dollars this year. It's actually the second time the Bank of Canada has tapered during the pandemic. Macklem reduced the bank's minimum weekly purchases in October when it had been at 5 billion Canadian initially. But at the time, officials characterised the taper as neutral in terms of stimulus because they shifted purchases towards long-term bonds concurrently. This time, the central bank acknowledged that its reduction of asset purchases will impact the incremental amount of stimulus being added to the economy by quantitative easing. Canada's dollar surged the most since June after the country's central bank said it plans to lower asset purchases by a quarter and indicated it may hike interest rates as early as next year, becoming the first major economy to indicate that it will start scaling back emergency stimulus. And the loonie outperformed all of its group of 10 currency peers, as the Bank of Canada said in spite of the latest lockdowns, it expects the economy to fully heal faster than expected. The announcement sparked a move higher in Canadian yields, with the 2-year tenor exceeding its US counterpart by about 16 basis points, the most since mid-March. Around 3 billion Canadian in currency futures traded within a 30-minute period after the announcement, the most in over 6 months. And the Bank of Canada's move to scale back debt purchases might fuel debate on whether its Australian counterpart is certain to extend its yield curve control and announce a third round of quantitative easing. As Governor Tiff Macklem is scaling back purchases of Canadian government debt by a quarter and accelerating the timetable for a possible interest rate increase at a time when Australia's economy is arguably outperforming its North American peer. Reserve Bank of Australia Governor Philip Lowe will have a close eye on developments in Ottawa while he awaits a pickup in consumer prices and wages at home. Canada does give you a flavour of what happens when your trajectory is stronger than anticipated. Slack reduced faster than anticipated. And so I think the RBA will be watching reasonably closely, says Sue Lin Ong, Head of Australian Economic and Fixed Income Strategy of the Royal Bank of Canada. What it does do here is increase the debate on whether QE3 is really a done deal. Canada's currency posted its biggest gains since June in response to the tapering, the sort of response that would spook policymakers down under, desperate to keep a lid on the Aussie. Bond yields also rose, but not by an alarming degree, while equities gained. Yet Canada is experiencing core inflation close to its 2% target, which is very different to sluggish gains in Australia, and helps to explain its early mover status. The RBA and the Bank of Canada were some of the first central banks to move after the global financial crisis. Is the playbook going to be the same this time for central banks? No, said Kerry Craig, the global market strategist at JP Morgan Asset Management in Melbourne. There's a lot more focus on the jobs market, wages growth now, and for the RBA. Lowe has also subtly shifted the focus toward the need for much stronger wages growth before changing the policy stance. He wants to see wages growth above 3% to sustainably generate inflation consistent with the bank's 2 to 3% target. Australia's labour market has been a source of strength. The jobless rate fell to 5.6% last month, just shy of the level the bank predicted it would be at the end of 2022. As a result, the RBA will likely lift its economic growth and employment expectations when it releases updated forecasts a little later. Yet traders are perhaps a little less bullish that Canada's move is the beginning of a global policy shift, given renewed outbreaks of COVID-19 that threatens to further damage global growth. We are in this twilight zone for central banks like the Bank of Canada. There's concerns about the virus and potential for it to reignite, so bond traders are still circumspect, said Prashant Newha, senior rates strategist at TD Securities in Singapore. If we don't have the risk of the virus in the background, it'd be potentially a different story in bond markets. And RBC's Ong detects a shift in the RBA's communication about whether to roll over its 3-year yield target to the November 2024 bond from the current April 2024. Increasingly, we thought the language from the RBA has shifted towards the odds of rolling to the November 2024 declining, she said. That would be a step consistent with the ongoing upside surprises in Australia. In minutes of its April policy meeting released on Tuesday, Australia's central bank repeated that it would make a decision later in the year. In considering this issue, members would give close attention to the flow of economic data and the outlook for inflation and employment, it said. JP Morgan's Craig suggests that Canada will be less influential on expectations for Australia's policy outlook than might normally be the case, as the significance of the currency for the RBA means the Federal Reserve and the dollar are key. If there's one central bank the RBA will be focused on, it's the Fed, he said. The Fed's balance sheet and their asset program will dictate the RBA's path more than any other peer. But I just want to remind you that to unwind all of the quantitative easing and to reduce the debt and to lift interest rates will create massive economic shocks. And frankly, even if they try to inflate their way out of the current situation that they're in, this is going to be a very considerably difficult task. And as we said earlier on, the virus ain't gone yet. So whilst locally we have a few outbreaks in quarantine hotels, internationally the story is much, much worse. And of course the risk is that we get another bout of virus in the community in Australia, which would of course set things back once again. So we remain tentatively sitting on this knife edge, and really I'm afraid that I don't see any significant evidence yet of any central bank anywhere really seriously beginning to engineer a U-turn to try and normalise the economic situation. We're going to have more QE, we're going to have more low rates, we're going to have more liquidity injections to help the banking system lend more, but none of this takes us necessarily in the right direction in my view. And that is the challenge that no central bank, even Canada in my view, has really started to embrace yet. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.